Well, undoubtedly, there has been no shortage of Sturm und Drang concerning the performance of the stock market in the first quarter of the year. But if we really look at it in context, the S&P 500 was down something in the neighborhood of I think it was 4.6%, so less than 5%, after 3 consecutive years increasing in excess of 20%. So I don't think that it should be much of a surprise that we're having a little bit of a pullback and also a bit of change in terms of the style of the types of stocks that have been performing. And what I'm referring to is the rotation between value and growth stocks. And of course, the single biggest value rotation that's out there in the market right now has been energy. Energy, I believe in the first quarter, it was the only sector that registered a positive return. And it was a sector that had been in the doldrums for years and years and had become very, very inexpensive. And so if you look at things from a value perspective, the fact that energy has had the very strong rebound that it has, that in and of itself would prompt that sort of growth versus value reversal. You know, the Federal Reserve clearly needs to act in response to the inflation numbers that we've seen over the past several months. There certainly was a strong hope that this inflation would turn out to be transitory and we'd be back to a more normalized inflation environment. That has yet to happen. So it's not unexpected that we would see some market response to that increase in interest rates, and also that we would see some difference in the types of companies that respond to that environment.
Well, I think it would be an understatement to say that world events have been turbulent during the first quarter. And as odd as it may sound, it was only in January that the Omicron peak of the coronavirus occurred. And it seems like that was a year ago now, with all of the intervening events. One particular area of turbulence is inflation. And we have kind of cross currents because there's supply side issues, which means the availability of goods and services. On the demand side, we've got a continued recovery from the coronavirus. We've got a strong labor market in the United States. So the Federal Reserve is trying to slow that down a little bit. The other thing to note is the supply side parts of inflation, where you've got rising prices for goods that are kind of inelastic in demand. And that can have sort of a self-limiting impact on inflation. You need both sides in order for inflation to develop this self-perpetuating cycle. And I think that's kind of what the Federal Reserve is trying to pull back on, but we may see that the supply side is also helping control inflation by making it harder for people to keep their budgets.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting sextantfunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Sextant funds in a free prospectus or summary prospectus, please visit sextantfunds.com or call 1-800-728-8762.